We met a client whose previous advisor recently retired and on the way out the door sold this client 4 privately held real estate investment trusts. Don't let this happen to you. Hi, my name is Robin Dolezal and this is Alex Pars. Together we are with Ironwood Financial here in Tucson, Arizona. We run into lots of clients who come in and who've purchased a privately held real estate investment trust. The problem is they don't know how the real estate investment trust is actually performing, and unfortunately we held to this for about 7 to 10 years and at the end really have no idea how this will actually perform. Today we want to discuss the differences between a privately held real estate investment trust and a publicly traded real estate investment trust. Alex, walk us through the differences.
There's really 3 main differences that we want to talk about today. The first difference is the illiquidity. Okay, as Robin mentioned, when you buy a private REIT, you're tying up your money for a period of time, usually somewhere in the neighborhood of 7 to 10 years. These things sometimes do extend that time on you without your say-so. In the meantime, it's very, very difficult for you to get rid of them if that's at all an option, or for a reasonable amount of money. You can always sell them for pennies on the dollar. So that's the number one difference between a publicly traded REIT and a private REIT. A publicly traded REIT, you can trade just like a stock. You can buy and sell at any time when the market's open. The second thing that you see that's different between the two is that private REITs, you really have no idea what they're worth. They send you a statement, $10. Next month, $10. Next month, $10. They really don't change. The value maybe changes once per year when they do an audit, but it doesn't necessarily reflect the true market value of these things. Whereas your publicly traded REITs, they change by the minute or even by the second, so you have a much better idea of what the value is. The problem with that is when the time comes at the end of this privately held REITs, you could be in for a really big shock. So maybe it's trading at $10 and then it goes public, which is one of the ways these things can, end their life cycle, if you will. They go public and suddenly it's trading at $4. You just lost 60%. Well, you didn't really just lose 60%. You lost that 60% over the last 10 years. You just didn't know it yet. Okay, so that's one of the real problems we see with private REITs is the lack of transparency. You have no idea what they're doing on a day-to-day basis, how they're performing, and you really have to just trust the company to be telling you all the facts, which in our experience isn't always the case. The third and final difference between a publicly traded REIT and a privately traded REIT is a private REIT often has a commission baked into it, whereas the public ones don't. You may have to pay a commission to do the trade, but usually in this day and age, that's a couple bucks, if anything. Okay, a private REIT can have a significant commission hidden inside of it. That can be one of the factors that contributes to them not performing as well as they could otherwise have. So those are really the 3 main differences between public REITs and private REITs. Something you need to be aware of before you even consider buying one of them is what are all the different caveats, nuances, fees, holding period, liquidity options. And again, just because they tell you in the prospectus, we plan to pay a 7% dividend, doesn't mean they're going to, and it doesn't mean that they're going to maintain value while paying that dividend. For more information, check out our website, ironwoodfinancial.com, or give us a call, 520-318-4600, if you'd like to meet us and sit down with us. Thanks for watching.